it's a numbers game. We've got to go out there and I tell everyone, if the motivation is yesterday's price, that's not motivation. I can't work miracles. If prices have dropped 15, 20%, I'm not going to be able to get that for you, right? But we can look at the numbers and see what a realistic range is. And if you're realistic on price, we can still achieve the range that we've come to together.
How important is your pro forma? And how do you make it as accurate as possible? Our guest today has been in that process, has done that hundreds of times and helped so many operators. He is a broker and he's seen many pro formas. And we're going to talk about the pro forma and how to get it as accurate as possible. One thing we can guarantee is that it's never going to be 100% accurate, right? However, there are common mistakes that people make and that our guest today has seen. He's going to dive into some of those. He's also going to dive in on reserves, right? I often ask guests about their reserves and how they calculated that, why that amount of reserve was necessary or why not. And I know you as a listener, if you've been listening very long, you've heard many different operators on the show talk about a different way that they calculate reserve, the amount of reserves that they need. Yes, the lender requires a certain amount, but I also in our bank as well, just for that emergency fund, right? And you're going to hear our guest today, Doug Banerjee, talk about that, but he's going to go through a pro forma and the things that in detail that you need to be considering as you're talking through this with your management company, whether third party or whether they're in-house. You're going to hear him elaborate on many things, even some metrics that he uses in-house and his CRM. I hope you listened to yesterday's show. You will have heard his expertise right in this industry. But he's a senior managing director at Greysteel. He's a sales broker in Dallas, Texas. He has a very large radius of markets that he's focused on, specifically multifamily, but this is going to apply to any asset class that you're looking at. Whether you're passive or active, you're going to learn a lot today from Doug. Welcome back to the show. I want to remind the listeners to go and listen to yesterday's show if you haven't already, where Doug broke down many things about commercial real estate that you need to know in today's market, even what he expects over the next 6, 8, 12 months. And I just think whether you're a passive investor or whether you're an active operator, you need to hear yesterday's episode as well. And then we're going to dive in today on some more things about real estate and like I said, I mentioned this yesterday, but any asset class. So maybe we'll talk about multifamily specifically today, but I just think you need to think through some of this, no matter what asset class you're in, or whether you're a passive investor or whether you're active. Yeah, you need to think through some of the things that Doug's going to share with us just in a moment. But Doug, welcome back, and let's dive right into this pro forma budgeting and what that looks like. I feel like it's not talked about enough, and it's something that is crucially important, right?
Sure.
And so let's dive in there, but welcome back.
I appreciate it. Let's start from the top down, meaning starting with income, right? When you buy a property or invest in a property, it's hopefully occupied and generating some sort of income, starting with rents. So looking at the rents that are being achieved today and what some of the competing properties nearby are getting, right? And if they're getting higher rents, then you want to do some improvements ideally and strive for those higher rents. You're going to have vacancy loss. You're going to have loss to lease, which is the difference between what you call your market rent for each floor plan and what you actually contract that rent for each individual. So if market rent is $800 for a one bedroom, but you run it out or your management team rents it out for 750, you have a $50 loss to lease. That, assuming it's a 12-month lease, is going to carry for that 12-month period or $600 total for the year. Then you have other income items. So you have application fees, late fees. You might be what we call rubbing back for utilities. Rub means ratio utility billing, and that's just where you're charging a portion of the utility expense back to the tenant. And typically your management team is hiring a third party to calculate that ratio based on square footage, number of occupants in the units, and sending that bill to the tenant. And then your management team is billing for the rent. So that's going to be your income side. And you as if you're a limited partner, you're not going to determine those things, but it's going to be important that your general partner, whoever you're investing with, understands those things and is taking those steps and you understand the management team that ultimately is going to be responsible for the day-to-day operations of that property. So going back to some things I mentioned on the last episode, if you fully vetted your general partner and your management team, presumably you've visited one or more properties that they already own and operate to see how those properties look and what the team is doing so that you feel comfortable they're going to be able to do the same thing on any deal that you're investing in. If you see a lot of things that don't look good, that's going to raise some questions and maybe some red flags to say, yeah, I don't know if this is the right partner for me to invest with. Going on to the expense side, right? So the management company is normally going to be or is going to be responsible for hiring and firing the what we call kind of in-house or management personnel, right, who are in the office, and then the folks who are out in the field, your maintenance personnel. So a rough rule of thumb, one in and one out for every 100 units. If you and you can of course have one in and one out for less than 100 units, but if you have more than 100 units, it's going to be pretty difficult for one manager and one maintenance guy to operate that many units by themselves. So that's kind of a general rule of thumb. So making sure that the payroll is being budgeted properly and the management team, of course, if they are managing thousands of units, they're going to have a process in place for hiring and firing folks and holding them accountable. But looking at the budgets and what I like to do as a broker, I've underwritten thousands of deals. So I typically know the management companies and how they've operated because we've underwritten a lot of deals where they've been the management company for a number of operators. So I have a pretty good sense for this property in this area that these management companies based off historical performance are going to do a good job. But a pro forma, which is a projection on what the income and expenses are going to be, is of course, right? You need that for your asset, but the historical performance, not only at that asset, if it's the same management company, I think that can be very helpful. If it's another management company, less so, but certain things like utility expenses are not going to change a whole lot unless you're going in and signing a new contract or implementing a water conservation effort, for example. And we can talk more about that. But looking at maybe a profit and loss statement for a similar size property or similar vintage property in the same area that management company is already operating, right? And just asking for the trailing 12-month P&L. A lot of times that information is going to want to be held confidential. They can black out the name of the property, but just seeing how historically they have a 100-unit property 2 miles away, what their repairs and maintenance and personnel and everything else have run at to make sure that that aligns with the pro forma that they're putting in front of you or your operating partner. So you got all these high level repairs and maintenance, which is just your supplies. And if you're contracting out different things like make readies, et cetera, that's going to be one line item. You've got contract services, which to us is when we underwrite, that's going to be landscaping, pest control, and security that fall under contract services. A lot of lenders will also plug trash in that same line item. We separate trash as a separate line item and kind of treat it more like a utility. You've got administrative expenses, so supplies in the office, software, subscriptions, computers, etc. So looking at that, and that's normally going to be on the lower end. Payroll is going to be one of your bigger expenses. So going back on what I just touched on as far as how many people they have in the office, how many people they have out in the field working on units and repairs. Insurance, big item today. So normally your operating partner is going to have an insurance broker that they work with that's going to go out to the different carriers and shop them and get some quotes, but just kind of making sure that the insurance is being modeled appropriately on a pro forma basis. Because what I just mentioned on historical numbers, forget about insurance and taxes. Those, whatever happened in the past really doesn't matter. It's what is your new premium going to be? So getting updated quotes on insurance and then projections on the real estate taxes is very important because those are non-controllable items. Everything else that I kind of mentioned before, for the most part, the management company is going to be in charge of and be able to kind of control those expenses. And then you've got management fee. So your operating partner is going to negotiate what that fee is going to be, a percentage of the effective gross revenue. So bigger properties, 200 plus units, are going to have a lower percentage fee, but the whole dollars, of course, are going to be higher. And then a smaller property, assuming it has on-site staff, you might see as high as like a 5% of EGR management fee. And then you've got replacement reserves, which are what we call below the line, but all the permanent lenders, so Fannie Mae, Freddie Mac, CMBS loans, HUD, are going to require replacement reserves to be escrowed, and those can only be used and reimbursed for capital items such as replacing roofs or mechanical systems or plumbing or making upgrades to interiors or adding or upgrading amenities. So they can't be used for just normal kind of repair work that's done. So looking at all those different line items and the utilities, I kind of skipped over those, but electric, gas, and water are going to be your main utilities. So having an energy broker that you can work with on the electric and gas side of things that can kind of look at, if you're able to secure a new contract, seeing kind of what those options are, and if you're going to fix that for 1 year, 3 years, 5 years, whatever it may be, on an energy contract. And then looking at gas, a lot of times you can't really negotiate the gas. It's going to be what it's going to be. And then the water sewer, you want to kind of look at what the consumption has been and if there's any way to reduce that consumption by inserting low flow toilets or shower heads or aerators, and having your maintenance team or a third party go in and fix leaks that they find along the way. So that can be some significant cost savings that we've seen, especially here in Texas, where water sewer costs can get extraordinarily high in some municipalities. So yeah, those are all the items that you kind of have to focus on or make sure that your general partner is focusing on. And once again, depending on the market, we're advisors. So a lot of times folks that are new to the market and don't already have a management team in-house or in place will ask us to make some introductions. So we normally like to make a few introductions, and a lot of times certain people are going to gel with one company more than others, right? And so we'll give you a few options and make some introductions and recommend you go meet with them and do all those steps that I mentioned, right? Visit a property, ask to see their profit and loss statement to see who you think you're going to be able to work best with.
Yeah, no, that's a great just breakdown right there. So anybody that's not extremely familiar when it comes to thinking through a performa and what your operator should be thinking about, or as the operator, maybe you haven't seen too many of these or haven't dove in yet. It's a great breakdown right there, and you appreciate the detail. Of course, I'd love to know. Obviously, you're even through the transaction process of lots of properties, right? And specifically in multifamily, where have you seen the mistakes made, right? When thinking through this pro forma, when operators are buying something, right? And they're trying to create this pro forma, they're working with their management company. Where were the mistakes made? Or 6 months in, right? They figure out, oh, wait a minute, we didn't project this correctly, or we didn't know about this thing, or where have you seen that happen?
Yeah, I mean, look, a pro forma, one thing that I can safely say is everybody's pro forma is probably gonna be wrong. So,
Yeah.
and I don't necessarily call it a mistake, but you wanna learn from the differences, right? And what you projected and what actually happened. Where I've seen mistakes made are on the execution and timing of, the value add, if you will. And especially the last couple of years, we've had a lot of supply chain issues. So parts weren't delivered on time. So you've got units that are sitting idle and vacant for longer than projected. So the income in the first year or 2 years comes in less than what your management team or general partner projected. And some of the costs, right, went up, right? Because there was a lot more demand than there was supply, especially with the supply chain issues. On the construction side, we saw a lot of deals that were kind of under budgeted on that end. So you've got kind of the renovation or CapEx budget mistakes. Operationally, there's things that we just can't control. But a lot of times I've seen folks that will model real estate taxes and insurance growing at 3% a year. right? Like all the other expenses. Well, we've had inflation, so a lot of costs have gone up. And so that's made a lot of the other expenses go up more than 3%. But then real estate taxes and insurance in general, in particular, I should say, have gone way up. 5 years ago in Dallas, I would say on average, we were underwriting insurance at 450 to 500 a unit. And now it's going to be 800 to 1,000 a unit because the replacement cost has gone up. So what the amount of dollars that are being insured on every property has gone up significantly, and then the rates have gone up as well. So if you were only modeling, you bought your property 5 years ago and you were only modeling a 3% compounding increase, that would probably be about a 20% increase. You would expect insurance to be at 550 to 600 a unit. Well, it's 50% higher than that, right? So that's a mistake or something where I think most groups weren't conservative enough. Similarly, on the real estate tax side of things, really having a good tax consultant that's going to advise you and of course use their historical and practical experience to help guide you on what your first year of taxes, which is normally your first or second year depending on when you bought the property, is going to be your biggest jump in assessed value. Because at least in Texas, right, a lot of these counties or appraisal districts are tracking sales, so when they see something trade hands, they're going to get more aggressive on that reassessment. And then after that, it's ideally not as heavy of a jump, but a 3% tax growth probably isn't enough. It's historically speaking, at least what I've seen, is probably going to be more like 5 to 15% a year, depending on the county and where your assessed value is when you bought it, right? So there's a lot of variables that you have to take into account. I've seen mistakes made on that. And the last thing would be payroll. And once again, some of these things are we couldn't control, but with COVID and all the inflation and the labor shortage that was incurred, wages have gone up quite a bit. So if you were only modeling payroll to go up 3% a year and that went up 15 or 20% to try to retain folks or hire new folks that have experience, then I've seen a lot of people be pretty under budgeted or under budget on payroll. That's another one that I would say has probably gone up in the last, I don't know, 10 years. It's gone up about 50% over the last 10 years, but a lot of that has been in the last 3 to 5 years.
Yeah, for sure. What about, and I don't know, some of these questions, it's hard to generalize, right? Because it could be so different per market and per operator and all these different variables. But just your thoughts on creating a successful performa with, say, in-house management versus third party. Just as you've worked with different groups, or your thoughts on that?
Yeah, I mean, I think it really depends on scale. A
Sure.
lot of groups that I've talked with aren't typically aren't gonna bring management in-house until they've reached 2 or 3,000 units or more, because it's a lot of work. But then you do have your hands on the controls and have a lot more just kind of control and knowledge on what's going on a day-to-day basis because you've got people reporting to you if the management is in-house. The advantages of going third party are you can kind of spread your wings a little bit more, right? And focus on the asset management side and kind of the bigger picture and let the professional management experts kind of go do their job. Because a lot of times, until you reach that scale of multiple thousands of units, you might not have the depth of vendor connections, right? Where a plumber is going to give you preferred pricing compared to a big management company that they know they're going to get dozens or hundreds of jobs from or have over the years, right? So there's a lot of pricing power for those larger management companies. So there's pros and cons to both. I think it just kind of depends on the size of your business and where you're geographically located. Because you might own 3,000 units, but if they're not in the same geography, it doesn't really benefit you from a scale standpoint for management purposes. Then you're, in my mind, better off interviewing and hiring a larger management company that has the vendor resources and can handle the hiring and firing of the on-site personnel.
Yeah, that's helpful. Yeah, very helpful. I just appreciate your thoughts on the pro forma and even in-house versus third-party management. Some of that, I think that's I've heard that many times what you said, and so or something similar. So appreciate your expertise, really, right? Your relationship with all these operators, and seeing who's doing what and what's most successful. And just to shift gears a little bit to a few final questions, Doug, as we even narrow down this segment, we talked about a few things you mentioned there, even in the pro forma. One thing we often talk about on the show is reserves, right? Reserves was like, and when somebody brings that up, I always say, well, how much is enough, right? Because I hear all over the board, well, we do it this way, or 1 month, or 3 months, or 6 months, or of expenses, or we get this much, and then we take the rest out. I mean, I've just heard so many different things. So I just wondered where you've seen most people as they're even thinking through this pro forma, right? Their reserves. We talked about actually the replacement reserves. Obviously, lenders are going to require things like that. But you see operators, how much does a typical operator have in reserves, or planning to have in reserves from day one? Kind of a just emergency type fund, or how do you normally see people calculate that? I get that question a lot.
Yeah, I mean, that's a great question, and I don't have a formula offhand, but one thing that we definitely model is when we're putting together our underwriting models, normally 1% of the purchase price for working capital. So if it's a $20 million deal, you've got $200,000 in working capital off the bat, right? And I would kind of look at that as that's where you want to keep your floor as far as just cash in the bank for a deal that size. And then, of course, you've got the lender required reserves,
Mhm.
which are normally going to be between 250 and 350 a unit. And that's going to be dictated based off their property condition report on the front end and what the physical asset looks like. And so they want to make sure that you're budgeting for a minimal amount over the time frame of the loan. So if it's a 5-year loan or 10-year loan, they're going to kind of project that out and then back into a monthly reserve. Normally that's never enough though, right? So 250 might be your reserve dictated by the lender, but in reality you end up spending much more than that. So I think it's making sure once again your management company is getting their vendors out there and putting together really good capex budgets to make sure that you're not under budgeting for those projects, whether those be big roof replacements or mechanical upgrades or just interior upgrades. But I think if you have that working capital set aside and you've done a good job budgeting on the front end, you're normally going to be okay. I do think that 3 to 6 months of kind of operating cash and debt service makes sense. I know during COVID, there were a lot of COVID reserves that Fannie Mae and Freddie Mac were requiring for 12 months of debt service that they would put into an escrow account until you reached a certain DSCR threshold. So there's a lot of different metrics out there, but I guess what I rely on most is just my general partner, the management team's kind of expertise and making sure that they've got a good solid capital budget on the front end and we've got working capital in the bank. We're not closing on the deal and don't have any cash, right, to start spending on because a lot of times the lenders are going to hold back funds and they'll reimburse you after that money's spent. Well, to be able to spend the money, you have to have some money in the bank.
Yeah, no, that's great. I just appreciate you elaborating because I often get that question, and because I hear it all over the place as far as different operators that we interview. So I'm grateful because you're connected to many operators and get to see their numbers, and so that's helpful. All right, a few different questions, Doug, and again, what's a way you've recently improved your business that we could apply to ours?
Hmm. So I'm always looking at in on the investment side of things, I've improved my business by just really spending more time focused on operations and making sure that we're setting what we call quarterly rocks for that business. And there's a book called Traction that talks about the EOS system, entrepreneurs operating system, and making sure you've got the right people in the right seats. So we've kind of followed that model as far as like building out our investment business and making sure that we're hiring people in the right seats and have a big focus on operations. So I think kind of taking a step back and looking at your org chart and making sure that you're supporting the people where they have needs and identifying those needs and rocks on a quarterly basis. There's likely going to be more issues or things that you can tackle in a quarterly period, But if you can kind of identify those top 3 to 5 and chip away, then I've seen in the last year, as I've had a little bit more time to do that, significant improvements on the investment side of my business. And, I try to do something similar with my brokerage business as well.
Yeah, that's helpful, and the audience should be very familiar with traction and actually another system I've talked about a little bit called EES, but it's very similar in rocks and all that. That's neat to hear how you're implementing that also. What about a challenge you're facing in your business right now?
There's 2 challenges. The brokerage business, finding motivated sellers, right? So it's a numbers game. We've got to go out there and I tell everyone, if the motivation is yesterday's price, that's not motivation. I can't work miracles. If prices have dropped 15, 20%, I'm not gonna be able to get that for you, right? But we can look at the numbers and see what a realistic range is, and if you're realistic on price, we can still achieve the range that we've come to together. Then there's other motivations, right? There's the 5 Ds that we're always looking at, so debt being a big one, right? If they have debt coming due, which we talked about pretty extensively on the last episode, there's a lot of bridge loans that are coming due. You've got death, you've got divorce, you've got partnership dissolution and just disaster, right? I had a client who exited the Texas markets because he just got tired of all the insurance costs that he was incurring with the hailstorms and the winter freeze. And so that was his motivation to get out of the deals. So he sold his last asset with us last year, and he's kind of more focused in regions of the country that don't have those natural disasters. So I'm looking for a lot of those things in my business.
What are some of the most important metrics that you track? Could be personally or professionally.
So professionally, I'm tracking what we have what we call the brokerage continuum. So it's going to be calls, meetings, proposals, listings, and closings. So we use a Salesforce-based CRM system, and for each of our producers, we're tracking those things. For myself, um, I don't have as many metrics on a personal level, but I do things that I'm part of an organization called EO, Entrepreneurs Organization in the Dallas chapter. And so I joined that 3.5 years ago just for kind of development purposes. And it's not real estate related. There's a lot of real estate professionals in there, but I've got 2 young kids. So I just kind of look at balancing my time and being very efficient with it during the work hours and then on the evenings and weekends with family. So it's a constant battle and challenge. Definitely nowhere near perfecting it, but try to make improvements little by little.
Yeah, that's awesome. I appreciate you mentioning something like EO in the metrics. I love how you laid that out. And you mentioned you all are using Salesforce.
Mhm.
Okay. How long have
Yep.
you all been with Salesforce?
So for a long time, over a decade.
Oh,
And
wow.
what's unique about Greysteel, we have a central CRM. So any new producer or team that joins our platform plugs in to the same Salesforce system, which doesn't happen in a lot of brokerage shops. A lot of brokerage shops will have siloed, they might share a CRM across a team or an office, but not across the whole company. Since we grew organically and were founded in January of 2012, so about 11 and a half years and 14 offices and 75 producers nationwide. One of the benefits I always tell our clients is that you're not only getting the benefit of the relationships that our team has, but of all the producers and support staff and all the data that's been input over the years into our CRM system.
What about some habits that you are disciplined about that have produced the highest return for you?
I would say I'm very from a professional standpoint, I'm very organized. I stay on top of my emails and I'll show people on my team just keeping my inbox clean. So I'm habitual about responding in 24 hours or less. And 24 hours would be long for me unless I'm somewhere that doesn't have, internet connection. But I'm very responsive. And so that's a trait that I think if you speak with anyone that's done business with me, they'll be like, yeah, Doug responds to me sometimes Saturday evening when other people, and for each their own, right? This is just my own kind of personal, but a lot of people will unplug when work lets out on Friday and won't replug until Monday. But I'm in a service based industry. And So I want to make sure that if somebody has something, I'm being responsive and at least acknowledging their want or need. So that's one thing. And I live off of my calendar, right? So similar to what you did to kind of schedule your podcasts, I use Calendly, and people can schedule 15-minute phone calls for me because they can view my calendar. It's in my signature block and book a quick call, and I'll call them because I'm available at that spot and it'll show when I'm busy. So I'm very organized and very efficient between the hours of 9 to 6 or 9 to 7, which is when I'm normally in the office after I drop my daughter off at school in the morning, and I'm focused on the workday.
Nice. No, I appreciate that. I also live by the calendar.
Mhm.
Have to. The team knows it has to be on the calendar. And so, and also, Doug, last question. How do you like to give back?
Yeah, so there's a few different ways. I've been fortunate in this business, having started back in late 2011, and we had a 11-year bull run in the real estate market. So it was great in kind of many different accounts. I learned a lot, was involved in a lot of different transactions. And so now I'm mentoring a lot of people, a lot of those being internal at Greysteel, but I went I was asked to go speak to some student athletes at SMU. Life After Ball is the name of the program, or lab for short. And Lisa Rollins, she heads that up. So I went and spoke to 20 or 25 student athletes across uh, all different sports. It used to be, I think, football specific, but then they opened up the program for all student athletes and just kind of talked about my career path and experiences and how you get into commercial real estate and what the different avenues are in commercial real estate. We've been talking about brokerage and investment, but there's also lending, development. There's a lot of different management. There's a lot of different things you can do in commercial real estate. So I like to go and speak and mentor folks. I donate to a number of charities. One of my best friend's cousins who was born with cystic fibrosis. So I've been a habitual donator to CF and have participated in a half Ironman for the cause in the past. And as a firm, we do quarterly kind of charity events. Now the name is escaping me that we're going to next month. Feed My Starving Children. So we're going up in Richardson and packing a bunch of different containers to kind of be shipped off all over the world, right? To feed children that are in need of nutrients and things like that. So we try to give back with our time, with our money, and just our expertise.
Awesome. Doug, it's been a pleasure to meet you and have you on the show. Just you have a lot of expertise that the listeners want, or our audience are looking for. So grateful for your time and being willing to share 2 episodes now. So many things about commercial real estate that's crucial for us to know whether you're passive or active. That's what I
Sure.
try to stress. It's like, I don't care if you're passive, you still need to be familiar with these things, right? And if you're active, you definitely need to be familiar with
Right.
these things. And so I'm grateful just to walk through what you look at in a pro forma, even the reserves discussion, how you elaborated on those things. And we're just grateful for your time. Tell the listeners again how they can get in touch with you and learn more about you.
Yeah, so Doug Banerjee, only Doug Banerjee in the world. So you can Google me and find me on LinkedIn. I love to connect with folks on there, and I like to post thought-provoking topics from time to time. So I have this thing I call daily discussion. A lot of times it'll be polls. So find me on LinkedIn or email D for Doug Banerjee, Banerjee at greysteel.com, GREYSTEEL.com.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.